Welcome back to the Deep Dive. Today we're focusing on, well, sustained success. We're going to dig into the Q2 FY26 results for Persistent Systems Ltd. And the headline number, it's pretty big, 22 consecutive quarters of revenue growth.
Yeah, that's quite a streak, especially, given how volatile the tech services market feels right now.
Exactly. So our mission today is really to go beyond just like listing the financials. We want to understand the how, the strategy behind this consistency. How are they actually using AI? How are they managing to expand profitability? And what does all this tell us about their ability to just keep delivering?
Well, starting right at the top line, the story this quarter is consistency meeting some really sharp profitability gains. Revenue hit $406.2 million. That's a strong 17.6% growth year on year.
Okay.
And crucially, in an environment where quarter-on-quarter growth is tough, they posted 4.4% growth in constant currency.
Right, that 4.4% COQ constant currency, that feels like solid execution. But like you said, profitability seems like the bigger story here. I mean, growing the top line is great, sure, but margin expansion, especially now, that really shows management discipline, doesn't it?
Absolutely. And the profitability numbers, they are striking. Their EBIT margin, it jumped to 16.3%.
16.3, okay.
And just to give you some perspective on that, in Indian rupee terms, the profit after tax saw, get this, 45.1% year-on-year growth.
Wow, 45%.
Yeah, that's not just, small tweaks that suggest they're running leaner, maybe higher value types of projects. These numbers, they stack up really well against their peers.
Okay, let's unpack that confidence then. For any IT services company, I mean, the best measure of future health isn't really last quarter's revenue, right? It's the pipeline, the next few years.
Yeah.
So we had to look at the order book. What are the contract wins, the PCV, the ACV telling us about their pipeline visibility?
The pipeline looks exceptionally strong. It points to a pretty clear runway ahead. Total contract value, TCV, for the quarter came in at $609.2 million.
Okay.
And importantly, new bookings made up $350.8 million of that TCV.
$609 million TCV is, yeah, that's huge. But you and I both know TCV can sometimes be, well, a bit of a vanity metric. I mean, it's a total value over maybe 5-7 years sometimes. How much of that is like immediate revenue? Guaranteed. That's where you get a bit skeptical.
That's a fair challenge, a necessary one. And that's exactly why we also look closely at annual contract value, the ACV. ACV is, what's more likely to turn into revenue over the next 12 months.
Right.
And ACV totaled $447.9 million this quarter. New bookings accounted for $254.4 million of that. So you combine the strong new ACV plus the conversion of older TCV deals.
Yeah.
Yeah, it gives management pretty high confidence in hitting future targets.
Got it. So the ACV, that's really the engine for next year's growth. Okay, shifting focus slightly. That momentum depends entirely on their land and expand strategy, right?
Right.
Taking a small project and growing it into something much bigger, more strategic. Did we see evidence of that, of clients maturing this quarter?
Oh, yes. Definitive proof, I'd say. The client growth metrics, they show a really clear, successful shift up the value chain towards those larger accounts year on year.
Let's get specific then. That 22nd quarter, it has to rely on the quality of revenue, not just the quantity, right?
Absolutely. Look at the cohorts spending $5 million plus annually.
Okay.
That number grew sharply from 43 clients last year to 56 this year.
56. Wow, that's a jump of 13 clients.
Exactly. And that jump, that's probably the clearest sign that, medium-sized clients are maturing into those really strategic, high-value accounts. It means they're not just winning more deals, they're actually deepening the relationships they already have.
Successfully. Yeah, that's the ultimate validation of that land and expand idea. What about the other tiers, the slightly smaller but still significant ones?
Well, clients spending $1 million plus, that increased from 184 to 191. Steady growth there.
Okay.
And if you look right at the top, the really transformative deals, clients in the $75 million plus bracket grew from 3 to 4.
One more in the top bracket.
Right. And when you see growth at all these levels, the million, the 5 million, the 75 million, it kind of tells you the sales engine and the delivery side are working together pretty seamlessly. They're graduating customers up the tiers.
So when we break down that overall 17.6% year-on-year revenue jump, we need to isolate the real drivers. Which business segments, which geographies were really pulling the weight this time?
Okay, on the segment side, the growth was emphatically led by BFSI, banking, financial services, insurance. It saw staggering growth, 30.0% year on year.
Wait, hold on. 30% growth in BFSI. That is massive. You hear about global banks being cautious, cutting costs. How did Persistent manage that? Was it acquisitions, or is this purely organic, maybe AI-led transformation?
It seems overwhelmingly organic and directly tied to how they've positioned themselves as an AI and specifically a Jane AI transformation partner. Financial firms, they were scrambling to cut costs, streamline legacy stuff, and that means deploying specialized AI tools pretty aggressively.
Right.
So that 30% figure, it really suggests Persistent is becoming the partner of choice for those mission-critical, high ROI transformation projects in finance.
Okay, that makes a lot of sense then.
Yeah.
What about the other segments?
Software, high-tech, and emerging industries grew by a solid 15.5%.
Hmm.
Healthcare and life sciences grew by a more moderate 6.6%. Although we should probably note healthcare has been a really strong performer in the past. So 6.6% off a high base is still, respectable.
Okay. Now, geographically, this is where I think there was a bit of a surprise. We usually focus on North America. It's the biggest market. But where did the real breakout growth come from this quarter?
Yeah, the standout was definitely Europe.
Yeah.
Europe delivered a dramatic year-on-year growth rate of 37.9%.
38%.
Almost 38%, yeah. North America posted strong growth too, 15.4%, kind of keeping pace with the company average, but nearly 38% in Europe. That signals a really successful strategic push there, maybe mirroring that BFSI strength we just talked about.
Yeah, 37.9%. It feels like they must have found a specific vertical or niche that's just exploding in the European market.
Yeah.
Okay, moving back to the segments. Let's connect this performance more directly to the tech. Can you give us some concrete examples of these big wins, especially focusing on how AI maybe sealed the deal?
Sure. Let's take the software high-tech vertical win first. They landed a large strategic deal using their own platform, SaaS VRO.
SaaSVO, right?
Yeah, they used it to accelerate and scale up AI infrastructure platforms for a fast-growing global provider.
Okay, hang on. SaaSV.
Yeah.
You need to pause there. That sounds like critical jargon.
Right,
What exactly is it in simple terms?
right. Good point. Think of SASV as Persistent's specialized toolkit. It's for speeding up AI deployment. It's their unique platform that helps companies basically get AI models out of the lab and into the real world at scale faster and more reliably than, the old ways. It's part of what makes them different from just a general IT consultant.
Got it. A deployment accelerator. Okay,
Yeah.
that explains the software win. Now back to that BFSI segment that grew 30%.
Right. In BFSI, they're using Gen AI to completely reimagine operations for a leading global wealth management firm, both back office and client-facing stuff.
So not just efficiency.
No, it goes beyond that. It includes creating Gen AI-based assistants for their relationship managers out in the field, giving advisors an AI co-pilot, essentially. That drives efficiency and potentially revenue.
Interesting. Okay, and finally, the healthcare win you mentioned.
Yeah, for a large U.S.-based nonprofit healthcare organization. The focus there was more on modernization and consolidation. They centralize a bunch of imaging applications. That helps strengthen data integrity, improves interoperability between systems.
Which in healthcare means better data flow, hopefully better patient outcomes, fewer errors.
Exactly. It's a high-stakes, high-value kind of win in that sector.
Yeah.
And look, these deal wins, they aren't just, random successes. They seem to be direct results of the company's pretty clearly defined strategy. AI-led, platform-driven, management has actually outlined 3 core pillars. They seem to cover the whole client transformation journey.
Okay, we hear AI strategy everywhere, though.
Mm-hmm.
Can you give us a clear way to understand these 3 pillars? Why do they matter specifically for Persistent?
Let's try a simple metaphor. Think of the company as managing a really advanced factory for its clients.
Okay,
All right.
a factory.
The first pillar is AI for technology. This is basically about making the factory itself run faster, more efficiently. It drives engineering hyperproductivity, faster time to market, better efficiency.
Okay, making the factory better.
Second pillar, AI for business. This is about designing smarter products inside the factory, using domain knowledge to reimagine workflows, maybe using autonomous AI agents. Smarter outputs.
Got.
And the final pillar, arguably the foundation for everything else, is enterprise data readiness for AI. This is like making sure the factory floor isn't clogged with, bad parts or bad data. It focuses on building secure, high-quality data foundations. You need that for broad, accurate AI adoption.
Okay, that factory metaphor actually helps clarify the structure. Now, you mentioned proof points earlier. A key test for any tech firm is always Do they use their own stuff?
Yeah.
How's this strategy playing out internally?
Yeah, that's a great question. And the internal adoption is already getting recognition. Their internal AI framework, they call it Persistent Assist. It recently won two pretty prestigious CII National AI Awards for 2025.
Oh, really? Which ones?
Best Industry Application for the framework itself, and also Best AI Solution Showcase for their Gen AI-powered IT support assistant, which they call IT Assist.
Yeah.
Winning awards for the tools you use internally, that's a pretty powerful demonstration that the product actually works well.
Yeah, that's the definition of eating your own dog food successfully, isn't it?
Yeah.
On the infrastructure side, I think there was also news about a new physical space to help with client transformation.
That's right. They just inaugurated a new state-of-the-art experience transformation studio in Pune. This physical space, it's designed to sort of rapidly blend design thinking with engineering, specifically for AI-powered outcomes. It shows they're investing seriously in the infrastructure needed to deliver on these Gen AI promises.
Okay, before we get into the nitty-gritty of the margin walk, let's just check in on the team itself. What's the state of their talent pool, their leadership? Especially thinking about this big AI mandate.
Well, the workforce is still growing. Total headcount reached 26,224. That's up 884 quarter on quarter. And the trailing 12-month attrition rate, it showed a slight improvement, which is good news. Dropped to 13.8%.
Slight improvement is better than none, especially with attrition being such a headache in this industry.
Any drop is positive.
And there was a key leadership change announced too, right?
Yes. Jaydeep Jok. He was previously the SVP leading BFSI, the segment that just grew 30%.
Right.
He was promoted to Chief Operating Officer, COO, effective August 12, 2025. And that promotion, it feels like a clear signal that AI delivery and execution discipline, they're now a C-suite priority, not just like an R&D project. His mandate explicitly includes overseeing delivery excellence and advancing the AI strategy across all the different verticals.
All right, let's talk money then. That 16.3% EBIT margin. It represents an 80 basis point net sequential increase. It's a very precise improvement. Can we break that down? What specific things actually contributed to that 80 basis point gain? We need to know where the tailwinds came from.
Yeah, this is where we see exactly how they kind of engineered that profitability boost. There were three main tailwinds. Together, they added up to about 170 basis point positive impact.
170 points positive.
Okay. First, a big chunk, 80 basis points, came from costs related to software licenses for a large multi-year customer deal that have now basically gone to zero.
Ah, okay, so that's essentially a one-time benefit. It won't repeat.
Correct. That's 80 basis points right there.
What else?
Second, favorable currency movements. That contributed 60 basis points.
Okay, currency, non-operational.
And third, they benefited by 30 basis points from some planned offshoring, specifically in the healthcare domain.
Okay, so let me see. 170 basis points of tailwind total. But 80 was from licenses ending, 60 from currency. That's 140 points that are either one-time or non-operational. Doesn't that mean the core sort of sustainable operational improvement like utilization or pricing was maybe only around 30 basis points? It suggests the underlying operational gain was much smaller than the headline jump.
It absolutely requires that nuance. You're right to point that out. And the management team, they seem acutely aware of the one-time nature of some of these tailwinds. And that's precisely why the forward context they gave is so critical.
Okay.
Global merit increments, pay rises, were rolled out effective October 1st, 2025. Management anticipates that'll be a significant headwind next quarter. About 180 basis points hit on margins.
Oh, 180 basis points down from salary increases? That's huge. How do they possibly plan to maintain margins with that kind of cost pressure?
Well, their plan is to offset about 80 to 100 basis points of that hit through a combination of other operational levers, things like improving utilization, more offshoring, maybe rationalizing subcontractor costs, and general SG&A optimization. It shows they're trying to run an extremely tight ship operationally, really relying on granular execution to absorb these big labor cost bumps.
Okay, that makes sense. Finally, let's quickly touch on the corporate side. There was a specific move involving restructuring a subsidiary. Why should we care about, corporate housekeeping in an earnings discussion focused on AI and growth?
It matters because I think it reveals the depth of their focus on efficiency, maybe even streamlining for speed.
Yeah.
The board approved transferring the 100% shareholding of Apona Group Limited, they're based in Ireland, from Persistent's U.S. subsidiary
Right.
directly to the parent company in India.
Okay, so essentially cleaning up the org chart, converting a step-down subsidiary into a direct wholly owned one.
Yeah.
And they specifically said the purpose was entity rationalization and operational efficiency.
Exactly. And look, it sounds like typical corporate paperwork, maybe tax motivated partly, but it also signals they might be streamlining their legal and operational framework. Why? Possibly to make sure nothing administrative holds back the kind of high velocity, high volume growth they're expecting from these core AI segments. Sometimes complex corporate structures can actually slow down fast global execution, so simplifying it now could be seen as a forward-looking strategic move to enable that speed.
Right. So this quarter, it really feels defined by that intense focus on execution discipline, doesn't it? The
Yep.
margin expansion, yes, but also the accelerating AI integration into, well, everything. Internal ops, client delivery, even the corporate structure like you just mentioned. They seem to be making steady progress toward that big goal. $2 billion in revenue by the end of FY27?
Absolutely. And maybe for you, the listener, the key takeaway or something to think about lies in that final corporate move we discussed. Given the aggressive, high-speed AI-led growth we're seeing in their main business lines, consider this. How often are these seemingly dry corporate restructuring actions, like moving a subsidiary around, actually necessary, not just for, compliance or tax efficiency, but as a critical internal operational lever, something needed to actually enable and streamline the kind of high-velocity transformation required to hit a huge target like $2 billion. It makes you think about corporate structure itself as a potential operational advantage or disadvantage.